How's everybody doing? I wanted to touch base with you today about something that is very important. You see, we're friends with a lot of entrepreneurs, business owners, and very successful professionals. But as we go through our conversations about their financial life, there's a few things that I always see a recurring theme showing up with respect to their 401k, and that they truly don't understand the value of it. One such illustration, I had a friend in our office and she was talking to me yesterday about her 401k at work, and I said, let me just take a peek at what's going on. She wasn't even contributing enough to get the match at her company's 401k plan. Now, what did that mean for her? She makes about $175,000. There's a 5% match. So by her contributing that 5%, or about $8,000 per year, she would have been guaranteed a return of $8,000. That's a 100% return. That is guaranteed. No questions asked, that she was not taking advantage of. But this brings up something bigger, in that most people, most entrepreneurs, most business owners are simply not contributing. Yes, they don't necessarily have the match because it's their own money that they're putting in, but there is a lot of value inside of the 401k. And I want to quantify that for you so you really understand what this means for your financial life and your net worth going forward. So let's run these numbers together. First, a 401k plan has two significant tax savings opportunities that I want to explore with you. And the first one is the tax deferral. Now, what do I mean by a tax deferral? So in our example, I'm going to use a married couple, and let's just say that the primary business owner earns about $270,000 per year, which is a nice, significant income. And let's say, for example, that she lives in New York City, where there is about state and local taxes of about 10%. So let's map this out together. So her income, $270,000. Being in New York City, having that type of income, she's going to have a tax bracket of about 42%. Now, when you have a 401k, you save money at your marginal tax brackets, which is the highest tax bracket that you're in. So being in the 42% combined tax bracket, she'll realize savings there. Now let's also assume that on her $270,000 of income, that she is going to contribute $50,000. You might say, that's a lot of money to save. And I'd say, yeah, it's a good amount of money, but it's not even 20% of her gross income. So that's something that's very feasible and should be doable. So if she's saving $50,000 in her 401k plan, she's going to get a tax deduction of 42% on that money because of the savings at her marginal bracket. This is $21,000 per year in tax savings. That's pretty significant, and that's an immediate guaranteed return as soon as you put the money into the 401k plan. That doesn't happen anywhere else. If you don't contribute there and you put the money in a savings account or in a taxable brokerage account, your tax bill is going to be $21,000 higher. That's going to impact your net worth quite significantly. But you might be saying, Matt, when I go to take that money out, I'm going to be taxed then. And you're all right. You are going to be taxed then. But are you going to be taxed at 42%? Very, very unlikely. Why? Because when we don't have a working income in the future, our income is likely not going to be nearly as high. Now let's walk through what that could look like when our client begins to pull that money out down the road. What happens when she wants to spend it? Let's fast forward 30 years, okay? And let's also assume, for example, that she has no other income sources. And when she goes to pull that money out, she might say, Matt, I need $75,000 in the future to live my life. So let's just put $75,000 up here. So what happens when she goes to pull $75,000 out of her 401k 30 years down the road? Well, the first $20,000 that she pulls out of her account in today's brackets, there's no tax on it. So she can take $20,000 out and not have any tax. The next $18,650 that she decides to pull out will be taxed at 10%. That's $1,865 in taxes at the current tax brackets. The next $57,000 that she could take from her 401k is at the 15% rate. But all she'll be taking out is about another $36,000, $37,000 to get to that 75. So what does that mean? That's about at 15%, another $5,300 in taxes. So in total, if she takes $75,000 out in the future, she'll pay about $7,300 in taxes federally, which is approximately a 10% tax bracket. So I put my money in today, I say 42% guaranteed. I take my money out in the future, I have 10% in taxes. So those two things combined is like a 32% automatic guaranteed return just by using your 401k plan and putting the money in. So that's one of the key benefits. Now, I didn't use any state taxes because perhaps our client is living in New York City, was tired of the winters and the nor'easters, and she says, look, I'm going to move down to Florida where there's no state income tax, which is a big possibility. And for our California friends, they might move to Las Vegas. So, but even so, even if there is some state tax of 5%, reduce that by 5% and you have a 27% guaranteed return. And even if my numbers are off a little bit, you still have a sizable guaranteed automatic return by putting money into that account that flows straight to your net worth. Now, let's talk about another valuable benefit of this 401k. That's the tax-free growth. This example assumed no growth in your investment account, no growth in earnings. And you might be telling me, Matt, the last 10, 15 years have been terrible. The real estate market crashed. We had a tech bubble. The Great Recession happened. Investments don't really perform. I'd say, historically speaking, a properly managed investment portfolio will generate returns. So in our example, we're going to assume that going forward, we put $50,000 into our 401k account, that it's going to grow at 7%. Now we have a choice, 401k or taxable. What the benefit of the 401k is that the 401k investments grow free of any tax friction. Now what do I mean by that? If we're going to generate a 7% return no matter where we put it, 2% of that is going to come in the form of dividends. Inside the 401k, those dividends aren't taxed. If we were to put $50,000 in our savings account or in an investment account, it is taxed. Dividends are taxed at a 15% tax rate. Okay? So that means inside our 401k, the $50,000 that we contribute grows at 7% because there's no taxes. But if we were to put that into the brokerage account, it's actually going to only earn 6.7% per year because of the tax on the dividends. Now, we're not taking into consideration any capital gains or any transactions, just straight up buy and hold and let our money grow and compound and not even think about it. Not advocating that that's the right way, but that's just the example here. So what does this mean? I put $50,000 in, my money grows at 7% per year. 30 years down the road, my 50K is worth $380K. However, outside of the 401k plan, if we put it in the taxable account, it grows to $350K. So on that one contribution of $50,000, over the next 30 years, just growing at 7% without taxes is a $30,000 benefit. You're right, it's going to be taxed when I pull it out. But what we saw here is we can pull that incremental money out at lower tax brackets than what we're saving it. So even if we have to pay 10 or 15% taxes, let's just put another $3,000 in tax, it leaves us with $27,000 better off on that one contribution, that one $50,000 contribution. Now repeat that year in and year out. So what does this mean? 27,000 on 350 is another 7.9% benefit just by using this account. Guaranteed just by putting your money in, as long as we invest our money intelligently. 32% plus 7.9% is approximately a 40% improvement just by contributing to the 401k account. Now I know that there's a lot of fancy investment strategies, and you as a business owner, an entrepreneur might think, I can't tie my money up forever. The bottom line is you can get your money out, and we'll talk about how to do that in future episodes, and we'll talk about how we can be investing differently than the traditional paths inside our 401k account. But just simply using this account has a ton of value that you need to be considering and you need to be taking advantage of. It is imperative for your financial life. So yes, there might be some additional investment expenses and additional costs that you need to be aware of, but even if we're off by 30% in our numbers, you're still going to have a 25% automatic improvement in your net worth from each contribution that you make. That's pretty sizable. That's something that you should be very considering. And if you have any questions, I'd be happy to discuss this further with you, and hopefully that you continue to live your best financial life. Thanks for listening. Talk to you again soon.